Hey everyone, welcome back to the Money Level Show where we think, act, and prosper. This is an early morning live stream. However, we're going to get into it today. Got a few things to cover before I have to get ready for my trip that I'm going on today, but I do want to cover a few things. And so I'm going to go ahead and kick the intro. We're going to talk about the Fed's next move. Are we going to go into an economic depression? I recently watched some grim interviews from Felix Zulauf and Simon Hunt. And so we're just going to talk about their predictions there, as well as jump into some stocks, crypto, and more. But for now, let's go ahead and hit the intro, and then we'll be right back.
Think. Act. And prosper. You are now tuned into the Money Level Show.
All right. We are back. I hope you all are doing well on this Monday morning. We're going to jump into the markets and everything. So excuse me, you all. I am being a little bougie, drinking some tea, trying to get my voice together this morning. So excuse me being comfortable in my own mini office, right? So let's go ahead and jump into the markets and see what is happening there. All right. So let's go ahead and jump over here to Yahoo Finance. It just gives me a one quick snapshot of what's happening. So as we can see, the futures are up. They're not up significantly, but this may be, who knows? This could be a breakout day. It could be where it just levels off. It could end up lower or whatnot. It's not really showing any signs of being highly, highly elevated. But, we'll see what happens with that. Crude oil is up $2, up 2.7%. It recently had just dropped to actually it was saying at 73.43%. That's as of market open today. So we can see that crude oil had fell significantly, and then even recently there's been some news on the U.S. bringing more production online and all these different things, and then you got OPEC wanting to do some more voluntary cuts, things of that nature. So crude oil fell significantly. The 60, 68 and some change, and then now it's bounced back to 73. I'm bullish on oil long term. I think that oil is going to go higher at some point. I think that it's still a necessary, I know that it's still a necessary commodity that we need in everyday life. However, if we're looking at recession or whatnot, these could be signs that we are headed in that direction because oil has been selling off. Oil usually sells off in recessions because people cut back on travel, people cut back on all different types of things. People lose their jobs and such, but obviously we haven't seen a whole lot of action in the unemployment market. It's showing some signs, but we're still excuse me. We're still a little far off. Let me take a drink real quick. All right, so let's jump over to gold. Gold had sold off, and now it's back. It popped back up. Let's see, it touched above the all-time high, a couple of weeks ago, and then pretty much, what happened was, I think my light went off. Pretty much what happened was we had gold sell off early December to 1977, somewhere around there, and then I was popped back up. I'm not really too sure on what's happening with gold now. I do, obviously you all know my long-term projection is that gold is going to go higher. However, why we had that recent sell-off, it could have been because we were highly elevated, and you could have had big sellers in the markets come, or you get a lot of put options. You get a lot of these paper market transactions and things like that happens, and gold will sell off. And so But I mean, it popped right back up. I mean, and there's it's kind of interesting because like even Costco is still seeing record sales with gold buying, especially with their gold bars and things of that nature. So, yeah, we'll see. We'll see what happens. Let's see. Bogues. Hey, good morning. Good morning, my friend. Good morning. Merry Christmas and Happy New Year to you as well. Appreciate you for joining in. So yeah, so as we can see, I mean, gold. I mean, I still don't have a really solid near-term prediction on it. Silver is still, hovering around 24. It rebounded a little bit as well. As we can see, we can look at a couple things. I mean, the U.S. dollar is up. I mean, on the yen, I mean, I think this is Japanese yen, U.S. dollar, currency in Japanese yen. I mean, it's up. So, I mean, the dollar isn't running. We do have the 10-year yield. It had pretty much sold off. I mean, it was at close to 5%. And then now it's at 3.9%. So when the yield goes down, usually stocks go up. So when this is going up, stocks are struggling and such. And then when this goes down, stocks are booming. I mean, and if you want like a bigger kind of look at that, I mean, you could look at here, in 2020, obviously when the pandemic happened, we had a huge drop in the yields. Fed held yields low for a long time. Stocks were running. I mean, yields were still low here at 1.6%, still very low. Stocks were running. And then, the Fed came and announced rate hikes around, October of 21. So then you begin to see the yield creep up. Stocks start getting sold off, plummeting, Russia, Ukraine, all these different things, right? The stocks just kept plummeting. And this is all most of the stock indexes. Not stock indexes. This is most of these stocks within the indexes. And I'm not talking about the Magnificent Seven. The Magnificent Seven, Meta, Netflix, all these companies, they still running, but they're holding the market up while a lot of these other companies are still significantly lower than their highs. And so that's something that we have to pay attention to. All right, so now just jumping over to crypto for a second. This is a coin I was buying, AVAX, called Avalanche, and they have all these different protocols and stuff. And I'm not even going to try to explain what they do. However, I bought it as a speculation. They've been on my radar for a while. Avalanche had recently, well, not recently, but its previous all-time high was $140. It dropped significantly, and down here, on the side, this is in market cap, but down here, Avalanche was trading at about $8 and some change, $9, and then Avalanche popped up to about $43, 44 bucks. So that was a cool little gain there. I wish I would have put a little more money there, but it's all about managing risk, and so I'm happy with the profits that I was able to take. However, a lot of the cryptos are running. They have since pulled back, but we'll see if they continue to run. Other cryptos that I've been dabbling in, obviously Cardano. Let me find that. Here it is. Cardano's ran significantly off. I mean, it was at $3.14 at its high. Dropped down to, I was buying here 25 cents, and then it popped back up to like 64 cents, somewhere around there, 67 cents. And then now it's back down to 56 cents. So many people could have doubled their money. Obviously, if you're putting a lot of money in, you can make some massive rewards, but it's all about managing risk. And so that's just another coin that has doubled. as of recently that I've been buying. Another coin that I've been buying is decentralized finance or decentralized social. And decentralized social, I mean, IPO significantly higher, but it was trading down here at $8. You know, got down to 820. I mean, I don't know if that's the ultimate low since the high, but it may have been lower than that. I mean, I think over here is a little lower, $5. But anyways, it popped up to about 20, 28, $29. And then now it's back down to 22. So that was another way to double your money in the market, in the crypto markets. So enough crypto. We're going to jump to the Fed and discuss what is the Fed doing and what do we project them to do next year. All right. So as we can see, this is the press release from the Federal Reserve in their last meeting on December 13th. Hang on just a second. Got to cut my alarm off because it's going to go off here shortly. All right, there we go. So the Fed came out, and we know that the Fed they haven't hiked rates since I think it was the middle of the year. It's been a while since they hiked rates, and they pretty much have been just making threats for like, oh, we may raise it one more hike. There's still been some talk of one more hike, and we're going to talk about, okay, why is that? Because a lot of people are projecting that the Fed is closer to lowering rates than raising rates. And within that as well, I mean, you're seeing that this play out in the markets as cryptocurrencies are starting to run. You see liquidity improving on a global scale. And so, but let's go ahead and dive into their statement. So it says, recent indicators suggest that growth of economic activity has slowed from a strong pace in the third quarter. Job gains have moderated since earlier in the year, but remain strong. And the unemployment rate has remained low. Inflation has eased over the past year, but remains elevated. The U.S. banking system is sound and resilient. Tighter financial and credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. So what they're saying there is that with the higher rates and credit lending being retracted, pretty much like people aren't able to access as much capital. They're having a lot of their excess cash being drained from the higher interest that they're paying on the debt, things like that. So it's a tighter financial and credit condition for households. And they're saying that this is likely going to weigh on economic activity, on hiring for businesses, because businesses have the cost of borrowing is more, and then also inflation. That inflation is going to reduce since people aren't going to be spending more, driving prices up. The extent of these effects remains uncertain. The committee remains highly attentive to inflation risk. Okay. So now it says the committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. In support of these goals, the committee decided to maintain a target rate range for the federal funds rate at 5.25% to 5.5%. So this means that they did not raise; they decided to maintain that target range. The committee will continue to assess additional information and its implications for monetary policy in determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time. The committee will take into account the cumulative tightening of monetary policy, the lags in which monetary policy affects economic activity and inflation, and economic and financial development. So they're saying, like, every time they do these rate hikes, there's a lag before it begins to weigh on these other aspects of inflation and economic activity. Obviously, we haven't seen the crash or anything of that nature yet. And that, so they're saying that it just comes with a lag. And meaning I've shown some of the stuff before where usually, recessions lag, anywhere from, it could be 8 months, 12 months, 24 months. We've seen, I think almost almost 3 years after the Fed begins hiking rates, that we begin to see a recession. And so, yeah, so there's still time in the play, and we could still see that, right? It's still in the cards. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities, as described in its previous announced plan. So there's still quantitative tightening, meaning they are selling debt off of their balance sheets. They're selling securities and any type of debt off of their balance sheets. The committee is strongly committed to returning inflation to its 2% objective. In assessing appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risk emerge that could impede the attainment of the committee's goals. So this is their way out. If they break something in the system and they want to go to cut rates, then pretty much, I mean, that's what they're saying. Like, they could adjust the stance of their monetary policy, meaning they could cut rates or reverse what they're doing as appropriate if risks emerge. So yeah. The committee's assessments will take into account a wide range of information, including readings on labor market conditions, inflation pressures and inflation expectations, and financial and international developments. All right, so that was the Fed statement from last week, and we're going to look at what is the Fed looking at, and if there's a possibility for another rate hike. Hey, Ryan James, dang, that's I'm sorry to hear that that you got laid off, and I'm hoping and praying that some other opportunity opens up for you, brother. So thank you for sharing and everything. So I hope that things turn around for you. So yeah, let's go ahead and jump over to what the Fed is actually looking at, right? All right, so this is what the Fed looks at. So oftentimes we look at the consumer price index, but the Fed looks at core inflation, and we're going to look at the difference here. All right, so core inflation, obviously, it's supposed to measure like the cost of a basket of goods, and it includes food and energy, right? So pretty much it says here, cost of living. Headline inflation is often closely related to shifts in cost of living, which provides useful information for consumers within the marketplace. The headline figure is not adjusted for seasonality or for the often volatile elements of food and energy prices, which are removed from the core CPI. So the Fed looks at the core CPI. We often look at just the CPI. So obviously, food and energy is volatile. It could be pretty much, I mean, that's what everyone spends it on. It seems like the Fed should look at that, but they don't. But I can see why they say, like, okay, this is something that is the seasonality. Oftentimes, there could be bottlenecks with certain things, whether that's, you have the trains, when people were striking, they were threatening to strike on the trains, and you begin to see the prices of agriculture and things of that nature go up, right? So those are some of the things that you look at, Russia, Ukraine, obviously. And so they're saying like these are volatile because of these other factors. They're not consistent factors like rent or shelter or, certain other things, electronics, things like that. And so that's why they removed it from there. But I think that it should be there, but it just is what it is, right? So it says headline inflation is usually quoted on an annualized basis, meaning that monthly headline figure of 4% inflation equates to a monthly rate that, if repeated for 12 months, would create 4% inflation over the year. So we know that headline inflation was 3.1%. So it's reduced significantly since the last time. Now, here's core inflation. So the Fed looks at this. Core inflation removes the CPI components that can exhibit large amounts of volatility from month to month, which can cause unwanted distortion to the headline figure. The most commonly removed factors are those related to the cost of food and energy. Food prices can be affected by factors outside of those attributed to the economy, such as environmental shifts that cause issues in the growth of crops. Energy costs, such as oil production, can be affected by forces outside of traditional supply and demand, such as political dissent. So like when we see OPEC, doing voluntary cuts and things of that nature, like that affects energy costs. So as you can see, the average core inflation from 1957 to 2018 was 3.64%. All-time high was 13.6% in June of 1980. And then we had 0% in May of 1957. And it says, as of 2018, the Federal Reserve's goal rate of core inflation is 2%. All right, so let's go ahead and look at their goal is 2%. As we can see here, the core consumer price index, it came in as 4% on December 12th. They forecasted 4%. And so it's still 2% pretty much double the their goals. So we had 4.8%. The Fed's been trying to get down to this 2% goal, and it's their inflation metric that they use has consistently been at 4%. So this means that, what does this mean? This means that, that's why they're keeping this little hawkish tone of like, okay, there's probably going to be one more rate hike, or there's going to be, they're going to stay tight. They're going to keep reducing their balance sheet, all these different things, right? Because they want to get to 2%. A lot of people are saying that the Fed would never get to 2% again. As we can see, it's been coming down, right? Since, let's see, last year, about a year ago, it's at 6%. It's been coming down. So like what they've been doing have been getting it down, but it's going to boil down to like the cost. What is it going to cost? What is it going to cost the economy? If they continue to raise rates, and if they continue to be tight and credit conditions stay higher for longer, right? So those are some of the things to look at. And this is like this brings me to like the interviews I recently watched with let's see, this shout out to Ryan again. It's been a week. Each day passing for like a week. On my way to an interview now. Hey man, I'm hoping, man, praying that you get that job, man, and that's the right thing for you. Because we all have to be able to take care of the things we need to take care of. So I'm hoping and praying for you, brother. Appreciate it. Simon Hunt, I watched a recent interview with Adam Taggart and Simon Hunt, as well as Felix Zulauf on a couple of, I think he was on Ted Oakley and David Lynn. And so both are well respected, financial guys, economists, whatever you want to call them, right? And they both predict that we're going to have a melt up in the markets this year. Simon Hunt and Felix Zulauf, they're about the same time frame. They say that we're going to have a melt up in stocks from about at the beginning of the year till about April, of the year, April of 2024 or something of that nature. We're going to have a run up. And when we have that run up, we're eventually going to have a sell off, and we're going to have a bust. And then we're going to follow by a really bad recession. Simon Hunt says we're going to have a depression of 7 years. about a 7-year depression. He says he could see the rates on the 10-year Treasury bonds going to 10%. Now, these are very, very contrary to what we've been hearing from a lot of other folks. Many folks believe that, oh, excuse me, I just knocked into my desk. Sorry about that, y'all. Many other folks believe that we are going to see the Fed cut rates soon in such. And so, which that's usually bullish for the markets. And so I'm kind of wondering, okay, if we're going to get this melt up, what is this going to look like? What are we going to sell? What am I going to sell? Things like that. I mean, I don't know what you all are going to do, but I'm kind of just keeping my eye open. I'm keeping my eye on the ball. And what I'm doing is positioning myself to continue to have some cash available to be able to deploy if we do have this event occur. And then also being able to manage risk. So if I'm getting run-ups in some of these stocks, cryptos, I'm taking profits off the table. And that's what I've been doing. As y'all could see early in the video, I showed y'all that I was buying Avalanche at $8-9. It popped up to $42. Best believe I took some profits off the table. Same thing with Cardano. I took some profits off the table and my money doubled. Decentralized Social, all these other ones, right? So my money's, doubled. I mean, my crypto portfolio pretty much caught up to my regular portfolio. So I just felt like I would be a fool if I wouldn't take profits. So I didn't sell all of it, but I did sell, some to cover my initial investment at least, and then some. So those are some things that I'm doing. Is like, okay, well, if I see signs that we're having a big run up, and I'm not gonna hold and wait until we see the top. Like that's not just realistic. I don't try to time tops and bottoms. I just try to be wise and, okay, let me take some money off the table. Let me take some profits off the table, here and there. So that's what I'm doing. That's what I'm keeping my eye on. I mean, obviously with uranium and some of the other commodities that I'm invested in, nuclear energy, oil, things like that. That's a longer decade play because we are going to need those resources. However, I'm not expecting like a significant run up from here until we have a bust in those particular commodities. And so, so I'm just kind of playing it by ear. I'm listening to some different voices, trying to assess the situation. I mean, because usually it boils down to people's timelines. So like Felix Zulauf and Simon Hunt may say like, hey, I expect this to happen then. And these are veterans in the game and they know their stuff, right? I'm not discrediting what they're saying or discounting what they're saying. What I'm doing is I'm taking what they're saying and I'm going to keep watching the markets. And I'm, if we start to see a significant run up, I'm going to be considering taking more profits off the table and becoming more liquid, especially if the market gets irrational. And this is something that they relate to. I mean, David Hunter could be put in the same boat, but they speak of a long-term cycle, a long-term debt cycle, and all these different cycles. So they watch these cycles and how you have these booms and busts and the nature of the cycles and all these different things, the nature of the ends of the cycles. And so for me, it's like, okay, I'm not going to be ignorant of what they're saying. I'm going to actually take heed to what they're saying, but I'm also going to position myself in a way to where I don't miss any gains from being too doom and gloom or whatnot, because it may play out a little bit differently than how one person is explaining it. It could be a mixture of views. We could have a run up for longer, than the first quarter, and then okay, then if we're in that situation, then maybe I took it, if I sold early or I, was too fearful and I took out profits a lot sooner and stuff, then I missed out on a lot of gains, right? Or whatnot. So I'm just kind of like just playing it by ear, just seeing what happens. So I just want to give that information to you all. I encourage you to go check those interviews out. Adam Taggart did one with Simon Hunt, and then David Lynn had Felix Zulauf on his show as well as Ted Oakley. But I have to get going, you all. I hope that you all have a good day today and everything. We will be in touch soon. I will be back live. I have another interview coming out soon. I have to just edit it and get it out. But this is with Justin Hune of the Uranium Insider. So as we dive deeper into uranium and what's happening in that market. So you all take care. Y'all have a blessed day, and I will see you all soon. All right, peace.